As we head into the last 2 weeks before the federal budget, one of the biggest variables is commodity prices. As we told you last week, Treasury is re-looking at its forecasting methods, having been way too conservative in recent years. Morningstar analyst John Mills does this for a living, and he notes commodity prices this year have been less volatile, theoretically making forecasting a little easier. That said, he's downgraded forecasts for iron ore and nickel and says gold could ease back from its current price above $2,000 an ounce. I spoke with him a little earlier.
We've modestly reduced our iron ore and thermal coal near-term assumptions. We now think iron ore is going to average about $100 US a tonne, down from about 110 over the next 3 years. And thermal coal has come down a similar amount as well. And look, it's just we saw late last year a big increase in the likes of iron ore and copper in particular as China did an about-face and reopened. And the market was very, very optimistic on that. But more recently, as you pointed out, those prices have come down as, I guess, a bit of optimism over China reopening has reduced. And things like worries over the world's financial system and various banks going bust in the US and elsewhere have taken precedence.
And just to explain to people broadly, if the world is going into recession, and we've seen the IMF forecast just in the last little while, you do get generally a slowing, a cooling of commodity prices simply because the demand won't be there, the industrial capacity won't be there if you've got a world that's going backwards.
Yeah, I mean, commodity prices are highly cyclical and they move around depending on expectations of economic growth. So if we do go into a recession, then you would expect commodity prices to go down, and the market has some expectation or some increased expectation that we will go into recession, given the Federal Reserve and other central banks have been raising interest rates recently.
And so does that naturally follow that your forecasts for Australia's commodity producers, the big companies, BHP, the Rios, the Fortescues, but then others, I mean, Oz Minerals being taken over by BHP right now, I know, but other commodity producers, that their prices therefore get adjusted in your mix once you put these new forecasts in?
Yeah, that's how we do things. I mean, we estimate our near-term prices based on futures to the extent there is an extensive futures market. So that's iron ore, copper, aluminium, thermal met coal, for example. Other prices or other commodities such as nickel, I mean, we look at the spot price and make adjustments depending on whether we think it's a reasonable estimate of the long-term cost. And so, look, we've reduced our iron ore and thermal coal prices, for instance, and so that leads to a reduction in our fair value estimates of the likes of BHP and Rio. I mean, they're not affected by coal not much. I mean, BHP has some coal, but definitely iron ore still dominates BHP and Rio, and obviously Fortescue, and so that will impact our fair value estimates.
But this also goes down to the production of these companies themselves. I noticed that, we mentioned earlier, South 32, the base metals miner spun out of BHP, has had a pretty decent share price fall today off the back of its latest quarterly production report. Now, this is really going to go down to weather. It's going to go down to operational, sort of capacity for these companies. And also then, as you point out, the market and the prices that they achieve.
Yeah, you're right. I mean, South 32 had a pretty disappointing report this morning. Production was down and costs are up. I mean, another thing to consider is what's happening with foreign exchange. And so if the Aussie dollar is down and has come down over the past quarter, that actually offsets a lot of the damage from lower, say, iron ore prices and thermal coal prices in particular for our thermal coal miners that we cover, such as Whitehaven and New Hope. So it's not just commodity prices, obviously foreign exchange as well is another big determinant of where our fair values end up.
But then those currency, those exchange rates also play a part in takeovers. Now, we've talked already about Oz Minerals and BHP, but then there's Newcrest and Newmont, Australia's biggest gold miner, effectively being taken out by what was once its parent company. Now, there's likely to be more takeovers, especially while the Australian dollar is down into the mid to low 60s.
Yeah, I mean, the Newcrest takeover offer from Newmont is a perfect example. I mean, the Aussie dollar is around 66, 67 US cents. I mean, a few years ago it was up at parity. And so the likes of Newmont, I mean, they're looking to expand their gold resources or reserves, and Newcrest is a perfect target for them. So, look, I mean, as you mentioned earlier, we've seen Oz Minerals get taken over by BHP, and if the Aussie dollar remains low, I would expect further takeovers.
It's going to be interesting to watch it, no doubt. John Mills from Morningstar, the commodities analyst there. Many thanks for your time today.